Well, hey there, everyone. Happy Friday, TGIF. Dave Keller here with Market Misbehavior, and welcome to Chart This with Dave Keller. Every trading day after the close, we like to recap what happened in the markets using the language of technical analysis and behavioral finance. Every Friday, we like to open up the Chart This mailbag, where a lot of fun questions have ended up through the course of our daily live streams. And Friday, take a deep breath, take a little time to reflect and answer some of these thoughtful questions from all of you guys. So we are live streaming on Facebook, YouTube, and X. I appreciate you guys tuning in live. You are welcome to ask questions as we go through the discussion today. We probably won't get to all the questions for sure that are being asked, but we'll put them in the mailbag and maybe we can feature them in a future episode. If you're watching the show on our YouTube channel later, thanks so much for checking it out. Feel free to share it with a couple thousand of your friends. That would help. Feel free to like and subscribe and hit alarm bells, whatever else you can do. That helps the algorithm share some market misbehavior magic with other investors that need help making better decisions. But we appreciate you asking questions, as always, using the comment section on our YouTube channel. What we're going to do today is look at what happened in the markets. It wasn't a great day, and it was interesting. It was one of those kind of tale of two sessions, right? The morning ended up being pretty strong. Honestly, you could probably even think about it in terms of four quarters. Like first quarter was between 9:30 and 11 a.m., kind of choppy sideways right around yesterday's close. Second quarter was from around 10:45 to 12:15 Eastern. Nice rally. Things looked really good. Looked like we might finish the week in a position of strength. Third quarter, kind of after lunch, we kind of gave back all of those gains from the late morning. And then the fourth quarter was sort of a choppy sideways period from around 2:30 p.m. to 4 p.m. Eastern. By the end of the day, we really didn't go anywhere. The S&P was basically flat. So we'll recap up just briefly what happened in the markets today, and then we'll get right to some of the questions that you guys have shared with me. And thanks so much for asking questions, for making this an interactive discussion, as always, and for following my work. I appreciate it a great deal. So what happened in the markets today, right? We talked about this sort of four-quarter behavior, the peak midday, back around 7,400 into the close. The S&P essentially unchanged. Let's note that the NASDAQ composite was down 0.6%. The Dow Industrials, a little more value-oriented, up 0.5%. Mid-caps up slightly, small caps flat for the day. Volatility coming in. We'll come back to some other asset classes, but I just want to talk about this. The S&P was flat for the day. When you look at the 11 S&P sectors, 10 of the 11 S&P sectors were up. Only one of them, the technology sector, was down 1.4%. So even though REITs were up 2.2%, even though materials were up almost 2%, even though consumer staples were up over 1%, the technology sector being down 1.4% is such a counterweight. Think of it like a seesaw. You got tech on one side and all the other sectors on the other side. That kind of evens out. And so that is the reality of our current situation with our benchmarks that are very growth oriented and dominated by technology, right? And so the technology sector gave back some gains. Micron was down pretty big today, as were other growth stocks. As a result, the S&P flat for the day. So this is why when we spend an inordinate amount of time talking about the charts of Nvidia and Broadcom and Micron, it's because of this. If those names are down, it really doesn't matter. If everything else is up, the S&P is going to be, at best, kind of flat. Now, this is a great situation, I would argue, if you're a stock picker and you're comfortable leaving technology, leaving the security blanket of tech and looking at other sectors like financials, like industrials, like materials, like staples, like REITs, because there's some pretty good charts in a lot of those sectors, as we can see just from today with a lot of those names moving higher. Let's just go back here. I just want to sort of set the table for that, because I think that's, for me, kind of the key takeaway with today's session. Volatility remains okay with the VIX around 18.5. That's good news. Rates kind of chopped around a bit, and we're going down in the morning, kind of turned higher in the afternoon as bonds sold off a bit. The 10-year yield finishes the week just below 4.7%. And the long bond yield just below 5.2%. The dollar up slightly today, but not by much. Gold and silver kind of did okay, and silver was one of the better performing assets today. Crude oil prices took a bit of a break after surging higher through the course of this week. Brent crude actually finished the week back below $100 a barrel, but let's be clear, crude oil prices have generally been accelerating to the upside through the course of this week. Cryptocurrencies all in the red, sort of rolled over earlier in today's session, and all 10 of the top coins tracked on stock charts in the red. Breadth was actually pretty good today, as I mentioned. Almost all the 11 S&P sectors were up. So that means on the New York Composite Index, about 60% advancers to 37% decliners. On the S&P, fantastic breadth, 72% of the S&P 500 members were up today. So most stocks were up. Tech was down, benchmark flat, is sort of the situation we're in today. Our market trend model is going to remain bearish on the short-term time frame. For my premium members, we'll dig into that a little bit more, talk about what that multi-week reading of short-term bearishness tells us in terms of the likelihood of further deterioration for the major equity indexes. Just to finish off here, hey, let's celebrate Apple, almost making a new all-time high today. So while tech was down, Apple continues to be a positive outlier, arguably the best chart in the Mag 7. I would say without argument, in my opinion, best chart in the Mag 7. But here's where the pain really accelerated. Micron, again, if you look at the little preview charts that I'm showing here, right? Micron doesn't get above $1,000, right? So you can see that short-term resistance around 1,000. Here's Broadcom bumping up against 400. SpaceX is just kind of a train wreck. So there are a couple stocks like that, Broadcom, Micron, kind of failing to get above big round number resistance. But here's I think another key story to think about. Tesla gapped lower Thursday on earnings, continued lower on Friday. Meta gapped lower on Thursday, continued lower on Friday. Amazon gapped lower on earnings on Thursday, continued lower on Friday. So if this is a bullish market environment, right? If this is the type of environment where I should be confident that the S&P is just going to rip higher from here, I would assume that buyers would be thrilled to come in and buy Amazon, Meta, and Tesla kind of stocks at a discount. But what we saw in Friday's session was there was additional selling after that gap down. So when stock investors get a 7% off coupon on great companies, if that's how we would describe some of these, and they don't take that offer, they don't take that bid, and they just continue to push it lower, for me, that is a sign of a market that is not in a bullish position, right? So we have to remember is short-term movements, right? One-day movements, one day to the next. What happens the day after a gap? These are short-term sentiment readings, but I would argue can tell you a lot about sort of investor psychology and where we're at. And I would say the lack of buyers coming in today was an important bullet point to Friday's session. We'll see what happens next week. We've got a lot more earnings, including a lot more growth stocks reporting. So we'll probably have many charts to review. We've also got a Fed meeting next week to debrief on, but I would say this is that's sort of where we're at with things. All right, that's enough of an update. Again, for my premium members, we'll have our weekly flight plan for you over the weekend. I consider that the most important thing I do every week for myself and for my followers. So consider becoming a premium member. No better day than today. Why not? Go to marketmisbehavior.com/premium to learn more about our premium memberships. Would love to see some of you join today after the show. All right, starting with question number one. And again, these come from people like you watching the show and throwing questions in during our live streams or just during at any point on our YouTube channel. Thanks for being a part of the community, and thanks for weighing in with questions that you're faced with. Here's question number one. I can see why some people trade the three times single stock ETF, right? Like the leveraged ETFs, but I don't understand why people would trade the single ETF instead of the stock itself. Could you explain? So interesting question. Are there stock ETFs that are single stock ETFs that don't have anything else other than it's just the stock? I don't think that's a thing, right? And if I'm wrong, give me a ticker of one that's the case. But when you think of stock ETF, the single stock ETFs have become much more prevalent, right? And I would say that comes from. I mean, there are ETFs and there are like exchange traded products, ETNs, like exchange traded notes that give you leveraged exposure. So like TSLL is direction funds, 2 times bull shares. The idea is it's a leverage like 2 times the daily move on Tesla. So Tesla's up 1%. This should be up 2% on a given day. So that's a thing. You also have these like income products, like the Yield Max has a number of these. A lot of times it's the first 3 letters of the underlying equity ticker and then a Y for yield. These actually are basically replicating a covered call strategy, right? So covered call strategy is an option strategy where you own a stock like Nvidia and then you write call options or you sell call options on a stock you already own. That's why it's a call that's covered by your other position. So covered call strategy, it's a pretty standard kind of way to manage risk. If you own a stock and you don't want to liquidate your position, but you want some downside protection, you could do a covered call strategy, which means you sell options on that stock. And so basically you're gaining some premium and protecting yourself a little bit. That's a way to like generate some income just in case the position moves against you. But I don't know of ETFs that just hold the stock and that's it. I mean, the single stock ETFs that I've worked with and have looked at, and I have yet to trade a single one of these because it's just not the way that I tend to think of things. It's either leveraged exposure, right? Double, triple the returns. It's inverse exposure. I want to go up when the stock goes down, or it's some sort of options like income strategy. And those have become more popular recently, where you have these sort of income strategies. And there are a bunch of these are buffer strategies. Basically, and what they're basically doing is putting in an ETF wrapper, something you could already do using a position in the stock and then using options, right? Using derivatives and swaps. Like you could replicate it. They're just basically doing that work for you and charging you a fee to do all that stuff. And then you just have to buy the ETF. You don't have to worry about having an options account and worrying about that kind of thing. So I don't know. I mean, that's kind of what I would say to that. I don't know of any ETFs that are literally just like an ETF that is the same exposure as owning a share of Apple. I don't think that's the thing because there's no, what's the business, right? Like, what are you paying a fee for the ETF for? So it's those other things. Do those options strategy? I mean, do like those yield strategies make sense? I mean, I don't disagree with it. I mean, I would say if you're comfortable enough, doing a covered call, it's a pretty low impact kind of options trade. Even if you're not big into options, that's not too hard. That a lot of brokerages make that pretty easy for you to do a covered call strategy. But the ETFs just give you a better, an easier wrapper if you don't want to get into that, and then you can just worry about owning ETFs, and that's it. So that's how I would describe that. Next question. If the 10-year continues to rise, even with the yield above 5%, can that lead to a recession or indicate a recession is more likely? History has shown the relationship between the 10-year and recessions. This is an interesting one. I actually got this earlier in the week and answered it briefly on the show, but I wanted to spend just a little more time because one of my favorite charts tracks this relationship, and it doesn't track the 10-year. It actually tracks there are a couple charts I want to show you now that I'm thinking about it. There are two that come to mind. One is looking at the spread. Is it this one? No, it's one of these. Sorry, I should have prepared ahead of time before this. There is a chart that I have that shows it shows the shape of the yield curve with recessions. And I think it's actually on a different chart list. It's on this one. And there's something that says, something that says like 10-year yield curve with recession. Here we go. So I wouldn't say it's with the 10-year Treasury. That's not what I would use to think about recessions. And I will tell you, just from a bunch of work that I did back in the day in my Fidelity years, we did a lot of research on rates, on the shape of the yield curve. We had some really cool collaboration with the fixed income portfolio managers and research teams about what things they looked for. And what we found was focusing on the shape of the yield curve, particularly inversions in the yield curve, was the most effective or most effective predictor of recessionary periods. And it was an inversion in the yield curve. So it's not as much where the 10-year is; it's where the short-term rates are relative to the 10-year. That was the secret sauce. So here we're doing a spread just between the 10-year and the 2-year Treasury yield. That's the black line, and I have the purple horizontal line showing you the 0% level, right? So if the line's at 0, that means that the 10 and 2-year yields are the same. So in a normal yield curve, it should be kind of sloping higher, right? That's kind of just the normal kind of term structure for Treasury yields, and that's because longer term we should be expecting higher yields for that, right? But when people are less optimistic about the future, the 10-year yield starts to come down, and then the short-term rates are higher than the long-term rates, and that inverted yield curve implies I would say pessimism about future economic growth. So when this spread goes below 0, the shaded areas are recessionary periods. And you can see that there's a pretty consistent leading indicator. It's a leading indicator. It's a pretty good relationship between the yield curve becoming inverted, the yield curve going back normal, and then a recession coming soon after. And what's also interesting is if you look at the performance of equities, and that's the bottom panel, that's the S&P 500, the market doesn't tend to do well during recessionary periods, right? Generally, equities are kind of going down or experiencing some sort of major corrective move during that period. So it's hard. And what's funny about recessions, right? Recessions, by definition, are 2 consecutive quarters of negative GDP growth. The problem is the way economic data is always reported on such a lag that, months after a recession, you can go back and say, oh, yeah, back then, 6 months ago, that was a recession. But we have learned that the inverted yield curve is a pretty good predictor of that. So you just look for the inverted yield curve because that actually, you can track when that's happening in real time. And so the yield curve going inverted and then going back positive usually means the market's going to have a corrective period soon after. And most recently we saw that, right? Like in 2000, coming off the COVID low, the yield curve went pretty normal there in 2021. Then it went big time inverted in 2023. 2024, kind of third quarter there, it went back to normal, and then we had that 2025 sell off pretty aggressively soon after that. We haven't had much of a pullback, and this is the first inverted yield curve in a while. It hasn't been that painful of a correction, but that's the relationship for me that is a much better one. So it is based on the level of the 10-year, but it's really more the 10-year, not relative to itself, but relative to the short end of the curve. And that inverted yield curve is something to watch for. Dave, would you consider Coinbase, Riot Platforms, and BitDeer the new leaders in the financial sector? The short answer is no. Do I think that is a very interesting area of the financial sector to watch? 100% yes. What we have to remember is, right, the financial sector has a number of different areas, right? So you've got sort of like the broker dealers, you've got the kind of investment banks, you've got the asset managers, you have the exchanges and data providers, you've got payment processors, you've got insurance companies, different types of insurance companies. So there's a bunch of different ones. So I would argue that that those names that you mentioned, things like Coinbase and others, are a great read on sort of a newer part of the financial sector, which would be, kind of the crypto play, right? And so, Coinbase, which you mentioned, Riot, for sure. And these are, honestly, those are generally more plays on cryptocurrencies than really more of a traditional, asset manager or traditional exchange like that. So would I consider those new leaders? Absolutely not. For me, the leaders in the financial sector are the big banks like Bank of America, Goldman Sachs, Morgan Stanley. And if you think that's like old school, I would wholeheartedly disagree, because remember, these are where the majority of the financial transactions are still kind of happening with these firms being intimately involved with it. And this is still the backbone of the financial market. So, names like Morgan Stanley, I would still consider to be sort of like the leaders in the group. Is this a unique and kind of emerging area of the financial sector that should be treated separately? I would argue yes. And, when I think of financials, I'm thinking usually of these spider ETFs. You have like KIE for insurance. KBE is the bank ETF. KRE is the regional banks. There's that broker dealer index ETF that I forget. Yes, the XBD, but yeah, IAI is a broker dealer. ETFs. I think ETFs like that track the different groups are really, really helpful. I would say Riot, Coinbase. These are other ones. They tend to be much more correlated with things like Bitcoin and Ethereum than they are with other financial listings. However, 3 good questions so far. Thanks for making me think and digging into the memory bank a little bit. Before we continue on, I do want to give a shout out to one of our partners, Koifin. Koifin is a fantastic product. If you are a financial advisor in particular, they really have built a platform designed to help you at a very low cost, enrich your relationships with clients, create compelling visuals, illustrate market activity, and think about things at the portfolio level. You can actually plug into different portfolio systems, get the holdings directly into Koifin, do some really cool attribution analysis, look at scenarios, run model portfolios, a lot of really good capabilities. And if you're an individual investor, you can use a lot of those same capabilities to really better understand what's happening with your portfolio and think about what could come next. If you go to marketmisbehavior.com/Koifin, you can get 20% off a new account. That's Koyfin. And thanks again to my friends at Koifin for being long-term supporters of Market Misbehavior. All right, let's continue on with some questions from all of you guys as we go. Number 4, when it comes to the documentation you write out for yourself, how often do you review them again? Do you ever spend some solid time going through all the monthly research notes? That's an awesome question. So that came from our webcast we did earlier this week. Did a webcast on the morning coffee routine. And if you caught that, I hope you enjoyed it. It was a lot of fun. And the replay info went out to everyone. If you signed up for it, you can access that replay here for the next week or so. We talked about routines and we talked about the importance of the daily, weekly, monthly routines. And this came up after the webcast. I didn't have time to answer it there, so I thought I would include it in today's episode. Yeah, I would say that's one of the things that's really beneficial for me and hopefully for you. Even if you don't share your market observations with another human being, the cool thing about having a blog or just a journal or something somewhere is that you can go back. And I, at least once a year, spend a deep amount of time, usually the week between Christmas and New Year's. I call it a power week, and I go through a bunch of different things. And I have 10 questions that I ask myself in terms of evaluating my performance, my process, my routines, my decision-making. And I've worked up these 10 questions. We'll do a webcast in December. Every December, I've done a webcast kind of talking about those 10 questions and then answering them together with all of you. It's a really therapeutic exercise, but it really forces you to recognize some wins and celebrate those and think about what went well and why, but then also focus on things you missed. And I have found it is so valuable to look at calls I've made that have been absolutely dead wrong. And everyone has them. And some have more than others, but I've had plenty. And I never seem to struggle to come up with things that that didn't go right. And what's great about having a show is I can actually go back and it's all date and timestamps. So I can know what I was thinking at the March low and I can see what I was talking about. And I think it's really helpful, for me thinking about the inflection points, right? Once there's a major low, what happened in the weeks after? Did I quickly enough recognize that change of character? After market tops, I always go back and review how quickly did I recognize that the evidence shift from clearly bullish to clearly not so bullish anymore. And I would encourage you to capture your own notes and do that. And I will show you this. This is actually our premium member community. So if you're Market Misbehavior premium member, you see something that looks like this. And I have the weekly flight plan and I have my monthly chart review and I have my daily market updates, all date and time stamped right there. So I can go back and everyone could go back and say, all right, what was Dave seeing at this particular moment? What was he talking about? And I think, reviewing that consistently has been so very valuable. So I would encourage you. I think for me, end of the year is a really good time to go back and force yourself to really think about the wins and the losses. And if you just follow my work in December, we will almost assuredly do a webcast where we talk about those 10 questions. And I encourage you to participate along with me. It's a really therapeutic, really helpful review process. Next question, Dave, do you ever refer to analyst ratings, CFRA, Schwab, etc. in your process? So it's a tough question when you ask about that, only because I mean, for me, as you probably know, my business is creating content, right? So it takes plenty of my mental capacities to just create my own content. So I often wish I had way more time to review what other people are thinking. That's one of the things I love the most, and that's probably selfishly why I have a Market Misbehavior podcast. It's not just to have great conversations that I can share with all of you. It's because it's helpful for me to reconnect with Ari Wald or JC Peretz or John Kalovis or Carter Worth, and just say, like, what are you seeing right now? What are you looking at? What stands out to you? What did you miss? What did you get right? Where are you seeing opportunities? And for me, that's actually a super important part of my process. And so forcing that's really why I started a podcast, was to make sure that I stayed connected to my peers whose work that I really appreciate and admire, just to see what they're thinking. It's another set of eyes looking at all of this information. So, if I was not a content creator and I was just, like an investor, how would I think about that? And how would I think of it for all of you? So analyst ratings, not so much. And I will tell you, and probably that is probably a clear bias from my work at Fidelity. When I worked at a big buy side firm, we spent a lot of time being very critical of broker research and believing that we could create our own research that was far superior in-house. And that was one of the motivating factors of having a good research, an internal research process. So I really gravitated away from, looking at external research. But what I did find was using quantitative models that drew on fundamental things like valuation and earnings revisions and stuff. That was really helpful for me. So instead of following analyst ratings, which I would say sell side analyst ratings are just generally skewed to being way too bullish, like way too many stocks are rated buy and strong buy all the time, versus what's actually what they should be rated, I would argue. But quantitative methodologies that look at fundamental data and basically apply that sort of approach, but in a very systematic way, I found very valuable. Latest episode of the Market Misbehavior podcast, by the way, I interviewed Steve Kress, who developed the quant model for Seeking Alpha and manages the Alpha Picks product and some of their products related to quantitative strategies. That was a great discussion that I hope you can check, which talks about why using systematic, versions of those fundamental themes can be quite helpful. And for me, especially for scanning, instead of like following a bunch of analysts and what they think, I just scan for stocks that rate pretty well on a valuation model or a growth model or an EPS model or whatever kind of fundamental thing I'm thinking about. And for me, that's much better than trying to track individual analysts and their thinking. So I tend basically to lean into quantitative approaches, and the ones that I've used regularly are Seeking Alpha. Mark Chaikin has a really good thing called like the Power Gauge that's pretty well done. That's a kind of composite fundamental and technical model. EPS Momentum is a platform that I've used that does a great job of quantifying earnings data. And then the IBD folks, right, I think do a really good job of taking Bill O'Neill's methodology for analyzing companies, but doing it in a scalable way, which for me is so important. Last questions. Well, and this also came from our webcast this week, by the way. Why is scanning for new 3-month highs of specific stocks not part of your morning coffee routine? Yeah, so in the webcast this week, we talked about, for me, the 3 really important routines: the daily, the weekly, and the monthly. And the weekly routine for me is the most important. I do, a good deal of analysis sort of over the weekend when things are quiet, when the markets are closed. For me, that's the perfect time to just like reflect on the data and what I learned in the week that just happened, kind of look forward at the week to come. And that's where I kind of really focus on how I feel like I want to be positioned. And I think of the daily activity as just kind of updating the analysis that I did over the weekend. Now, through the course of the trading day, I'm always looking for stocks that are breaking out and breaking down. So while it's not kind of part of those initial, charts that I look at, which are a little more macro oriented, through the course of the day, I'm always looking for what's moving. I'm looking at the heat map, which indicates big movements, of course, and stocks making new swing highs and new swing lows. That's just something I normally have as part of my process through the course of the trading day. Usually once a week, by the way, midweek, usually on Wednesday, I go through and make sure that I run those scans just so at least once every week, I'm paying special attention to stocks making new 3-month highs and new 3-month lows. So formally for me, that's part of the weekly routine. And I guess the reason for that is you can't look at everything every day, right? There's just there's a fire hose of data to look at. And so I have to be, and I think we all have to be pretty thoughtful and intentional about what data we need to consume every day, what's more of a weekly routine, what's more of a monthly routine. And for me, I'm always trying to kind of tweak that. And another part of that end of the year kind of 10 questions that I mentioned, a couple of those questions are all with the routine. Look at your morning coffee routine. What's one thing you could do to improve it? What's one thing you might want to take out of that routine? And I do that for the weekly process as well. That's really helpful to have a normal review where you look back and say, am I spending my time how I should? Hopefully what we do on this show and with my work elsewhere for market misbehavior gives you some ways that you could improve your routines going forward. Folks, those were some awesome questions. Those came from people like you watching the show this week and asking questions during our live stream or just dropping comments in our YouTube channel. And I appreciate you so much taking the time to do so. Please keep the questions coming. We appreciate it a great deal. It is a beautiful day here in Redmond, Washington. I am going to close out the live stream, change into some bike clothes, and get on the trail and ride the bike for a while. I hope you guys all have a joyful, restful weekend, taking some time to reflect on why we spend our times trying to grow our portfolios. There's a why out there for you, and I hope you spend some time this weekend reflecting on that. In the meantime, be well and stay safe, and we'll see you next week. And remember, it's always a good time to own good charts. Take care, folks.